So as the UK taxes are on the rise, many of the investors and business owners are looking into optimizing their taxes by going overseas or becoming a non-UK tax resident, such as moving to Dubai and declaring themselves to the HMRC that they're no longer a UK tax resident. Well, today we are joined by Laura Sent, who is a partner at LSR Partners, and we are going to find out what it really means to be a UK non-tax resident. Laura, welcome to the show today. Yeah, thank you for joining us.
Thanks for having me, Shiraz, as always.
So, as I have laid down, my first question is really going back to the basics of what does it really means to be a non-UK tax resident.
I suppose the main thing in terms of being a UK tax resident versus a UK tax non-resident, the starting point if you're a UK tax resident is that you're taxable on your worldwide income. If you're a UK tax non-resident, you're taxable only on your UK sources of income. And to an extent, there's some tax reliefs available in terms of certain types of investment income as well. So, for example, if you are an investor and you have global income and you're subject to tax on your worldwide income in the UK, if you were to leave the UK, there is like your overseas assets certainly would not be creating any UK tax liability whilst you're a UK tax non-resident.
If I come to the process of becoming a non-UK tax resident, what does one has to do in order to achieve this status?
So, in terms of becoming a UK tax non-resident, UK tax residency is determined by something called the statutory residence test, and it's a series of tests to determine whether you're considered resident or non-resident in the UK. The starting point is we look at the whole tax year, and we would work through a series of tests to determine whether you're either automatically non-resident in the UK, automatically resident in the UK, or whether, if it's not particularly clear cut, we may have to use something called the sufficient ties test to determine that assessment. In terms of being automatically non-resident, you might be non-resident by means of being physically present in the UK for few enough days for the first 3 years of non-residence. If you're in the UK for no more than 15 midnights, you'd be automatically non-resident. Thereafter, that day count gets increased to 45 days that you can be in the UK. Or alternatively, you can be considered non-resident by means of full-time work outside of the UK, which is, I say, a little bit more complicated to kind of meet the criteria of, but you have to be making sure that you are working full time for the whole tax year without any significant breaks, and you spend no more than 30 work days, which is where you work in the UK for more than 3 hours during the day in the UK, and no more than 90 midnights in the UK. So those are the tests for being kind of automatically non-resident in the UK. In terms of being automatically resident in the UK, there are three tests by which you can be considered automatically resident in the UK. First is, again, a physical presence test. So if you're in the UK for more than 183 days, so more than 6 months, you are going to be considered UK tax resident. There's a second test in relation to having your only home in the UK. So if you do have a kind of a 3 month period, only a chunk of that needs to be within the tax year, where you have your only home in the UK, you can be kind of dragged into the UK tax net for the whole of the tax year on the face of it. And the final test would be full-time work inside of the UK, which is fairly similar to full-time work outside of the UK, but you would be looking at a 365-day window, of which only one day needs to fall within a particular tax year.
Okay, thank you for those insights. So my next question would be that obviously when we help our clients move out of the UK, mostly we help them set up their company residency in Dubai, help them get a long-term UAE visa and a visa for their families as well. So that they make Dubai as their home base, and then they go back to the UK HMRC to declare them a non-UK tax resident. Now, my question is that from the HMRC's perspective, what is really needed to prove that they have become a non-UK tax resident, or it's just about taking a flight and going to Dubai and then just living outside of the UK for a few months?
So, HMRC should probably be notified that you're leaving the UK, and on the face of it, you can do one of two things. You could submit something called a Form P85 to let HMRC know that you're leaving the UK. Now, that usually would only tend to apply if you don't already file tax returns, and assuming that you're either an investor or own a company, the likelihood is you will be within the self-assessment tax system. So the other way that you can tell HMRC that you're either breaking or have broken UK tax residence is to declare it on your tax return. In terms of that, you would need to make sure you are completing the residence pages, which means that if you file your own tax return, you won't be able to file it through the government gateway account. You would need to use specialised tax software or kind of an agent to be able to file that return and notify HMRC. And you can fill in the residency pages to declare either that you have split year treatment on the year that you leave the UK, or alternatively that you are non-resident for a particular year.
That's helpful, but my question was on the idea of is there any proofs that we need to give to the HMRC when we are filing for non-residency, non-tax residency, that from a Dubai perspective, does there need to be any sort of proofs that an HMRC can ask for?
So, as a starting point, because self-assessment is self-assessment, the starting point is you don't need to demonstrate to HMRC, or you don't need to provide HMRC with any evidence when you file your tax return. However, HMRC have the ability to look into any tax return and request evidence to support your tax return. And in terms of when we're looking at things like UK tax residence, realistically having a good travel calendar which evidences how much time you spend inside and outside of the UK, and evidencing where you're undertaking work, for example, is something that would be really useful to keep records of. You may also want to keep evidence of boarding passes, potentially details of rental agreements, especially to demonstrate that you have a home outside of the UK and not, if you're keeping your home inside of the UK, for example. And just, for example, if you were employed, you might keep your work contract. If you're self-employed, you might keep contracts that you have with clients, or kind of keeping your accounting records to demonstrate that work is being physically undertaken outside of the UK.
Okay, thank you, Laura. So my next question is about the timeline. So let's say on the 1st of January, I decide to start this process of becoming a non-UK tax resident. What sort of timelines can someone expect in order to, first to leave the UK, and once they have left the UK, for HMRC to acknowledge their non-tax residency status? And then what is the cutoff date? Is it the date when I left the UK, or is it the date when the HMRC approved this status? So from a tax perspective, the tax liabilities are going to change based on when you were a resident and when you were a non-tax resident. So what is that date? How does that calculated? So the timelines of achieving that and the cutoff date. So can you please cover that?
So if you were to leave bang on the 6th of April, you'd effectively look at being non-resident for the whole of the year. If you were to leave midway through the year, so for example 1st of January, we can look in the UK at something called split year treatment. In terms of split year treatment on the way outside of the UK, there are 3 cases by which you can split the year. Case 1 is starting full-time work outside of the UK. Case 2 is being the partner of somebody starting full-time work outside of the UK. And Case 3 is ceasing to have a home in the UK. Now, there are different rules that will apply in order to meet the criteria of those 3 cases. And in terms of priority from HMRC's perspective, Case 1 will take priority over Case 2, which will take priority over Case 3. The reality is, if you are looking at splitting the tax year, you really do want to speak to a professional to make sure that you are comfortable with when your split year date will happen. On the face of it, once that year has been split and you are considered a UK tax non-resident, you would be treated as a UK tax non-resident from that date onwards. There are certain reliefs associated with what we call disregarded income in the UK when you're a UK tax non-resident. That would start from the year that you are considered to be fully non-resident. There are certain reliefs, for example, if you were liquidating your UK company and realising a capital gain, that would take effect from the point that you would become considered non-resident, even if that's midway through the year.
Okay, thank you. Laura, I have one more question on, obviously you touched upon that, from the point of view that if an investor has a home, a primary home that they own and it's not a rented home, that they can just cancel the lease, it's under their ownership. So once they leave the UK and maybe the family is also leaving with them, the home is left behind. Does that home ties the investor back to the UK tax residency in any way, or do they have to sell the home or rent it out, or they can just keep it as a second home where they come back in the vacations and then they leave? So what are the implications on the tax residency if they own and keep their primary home in UK?
So there are plenty of potential challenges associated with retaining your home in the UK when you leave the UK. However, on its own, it might not necessarily create any challenge or too many challenges associated with your UK tax residence position. Areas where I can see there being potential challenges associated with having your home in the UK. The first would be if you didn't have a home outside of the UK and you spend time in that home inside the UK. From HMRC's perspective, they could well consider you automatically resident in the UK by means of the second automatic UK test, which is only home in the UK. It would also create an accommodation tie for you. If you have 91 consecutive days where you have a home available to you and you spend one night in it, it would create this tie. And if you had to determine your UK tax residence position by means of the sufficient ties test, that could create or kind of reduce the amount of days that you could spend in the UK. The final consideration, and we've kind of, when we've been talking about tax residents, we've been looking at being domestically non-resident in the UK. Now, if you spend too many days in the UK and become domestically resident in the UK, but say, for example, you're also domestically resident in Dubai, at that point, we would need to look to the double tax treaty as to where you would be considered treaty residents. And if you have a permanent home available to you in the UK, you have to also make sure, in order to be able to kind of confirm that you're treaty resident in Dubai by means of your centre of vital interest being in Dubai, you also need to make sure you've got a permanent home available to you in Dubai, and kind of, I don't know, can't be kind of staying in an Airbnb to be claiming that from HMRC's perspective.
Okay, so Laura, my next question is about what are the common misconceptions that you see among investors who are trying to relocate or declare themselves a non-UK tax resident?
Great, so thank you. I suppose probably the top three that we kind of come across. The first is people who think that they can remain in the UK and create a company outside of the UK. I think for people who are kind of trading, there's a risk of creating a kind of a foreign controlled entity, which creates a whole bunch of corporation tax problems. For people who are having overseas investments and holding those in overseas entities as well, from HMRC's perspective, if they think that you're just trying to do it purely to avoid tax, they can effectively look beyond that structure anyway, and tax you as if the money wasn't even held in a company. So potentially the planning wouldn't necessarily be so sensible in that regard. So that would be the first one. The second is the concept of temporary non-residence, but effectively when people think, I don't want to pay tax on a particularly large distribution, or a like a distribution from their company, or a large dividend from their company. So I'm going to leave the UK for 1 year, and then I'll come back within the scope of UK taxation once I've taken this large distribution. At that point, from HMRC's perspective, they are likely to look beyond the fact that you've left the UK for a year. They are likely to consider you as temporary non-residents, and at the point when you return back to the UK, there's the creation of a large tax liability as well. The final say myth or misconception, probably just lack of understanding, is in the UK we do have something called disregarded income for people who are UK tax non-residents. It falls within the scope of kind of temporary non-residence rules as well, so it's something not to be dealt with kind of lightly. However, the assumption, well, kind of because the starting point is if you are non-resident, you're taxable only on your UK sources of income. If you are taking money from a UK company, the assumption might be that the starting point is that you're going to pay UK tax on that. The majority of investment income can be disregarded, meaning that effectively it would be taxed to the extent that it is considered to be taxed at source. And when you reach UK tax non-resident, HMRC allow a 8.75%, now the dividend tax rates have changed, tax credit on those dividends. So that would be the extent to which you would be taxed. Because it's a credit, you don't actually physically pay anything on those.
Thank you, Laura, for that. So, my final question is that if someone is actually looking to create a structure like this, where they move to Dubai and become a non-UK tax resident, declare themselves out of the HMRC's tax system, what could be the advice and what could be some potential next steps that you see for them taking in order to achieve these goals?
So I would suggest that if you are looking at relocating, it is worth speaking to advisors in both countries that are comfortable with the rules associated with tax residence, because the reality is you would be looking at potentially changing business structures. You want to get the timing right. For example, in the UK, there may be an optimal way to look at taking money out of the business depending on your future plans. And similarly, getting support in the country. So, for example, if you're going to Dubai, speak to you, because you want to make sure that you're getting things set up right, and at the right time.
Well, thank you, Laura, for your time today.
Thanks for having me.
So that's it for today. And if you want to move to Dubai and become a UK non-tax resident, you can reach out to me and Laura. You can book a one-on-one call in the description below, and we can help you get sorted on these things. That's it for today, and we'll see you in the next video.